Good day, traders. This is Dennis Wilburn with the Active Trend Traders. Welcome to the first in a series of tech tips we're going to be putting out over the next few months to give just little short snippets on certain technical analysis techniques and objectives. This is the first. How to buy the bottom. I want to remind everybody that all the materials that we present at the Active Trend Trader are for trading purposes only, and traders should always paper trade any new method prior to the risk of their own personal capital. Everybody wants, a lot of traders, they really think it is cool to be able to buy the exact bottom of either a stock or an index ETF as it drops, and then, I guess it gives you bragging rights to be able to say, hey, I got it right at the bottom. Unfortunately, that is a very low probability type of trade because oftentimes it hits a new low and then goes on to newer lows, especially if the trend is reversing. So one of the, today's tech tip, how to buy at the bottom. The basic suggestion is don't try. But here's a good approach is don't buy a new lower low unless, one, you have price at past support and is rebounding. Secondly, candlestick reversal patterns. Thirdly, your indicators are showing you some good positive divergence, which can say, hey, it is time to get in. A better way is to basically wait for the price action to prove itself. You hit a new low, and then the price action goes into some constructive price action, which means it bounces off the low and then goes up and does some consolidation and then moves back into a new, either a new uptrend or a continuation of the past uptrend. And then look for a retest and go. Buying the bottom requires practicing patience and discipline. Let's go over to the charts and take a real quick look. As we know, we have been having a fairly significant potential sell-off, a potential topping action in the markets. And I'll use the index ETF, the spiders, the index ETF for the S&P to demonstrate this aspect of buying the new low or waiting for the proper time. As we can see, we came up with the S&Ps, tested the previous highs for the year, and then started to sell off. And then we got a real major sell-off on 6/29, June 29th, because of some debt issues going on with Greece this year. As we can see, the index dropped down to a past level of support, which is the 200-day moving average in this case. However, did we have the other things going for us that said, hey, it's time to buy? No, not really. We had no positive divergence on the indicators. And as the price action works its way out over the next couple of days, we see we get a little bit of a turn and a bounce off the 200-day moving average, which this is a rebound. So one could say, hey, I'm taking this rebound with the stops immediately below this level. And so the next day, we get a little bit more of a rebound, but where does it rebound to? Right back up to a past level of support, which has now become resistance. A little bit higher into the resistance area with, as you can see, then a sell-off. And then finally, on this past Monday, July 6th, it sells off back down to the 50, back down to the 200-day moving average. And that does a little bit of a rebound, but as we can see here in these candles, it's looking kind of weak. Have we gotten any divergences yet? No. And then today, we get a continued sell-off where we now break below the old lower low to form now a new lower low. And as you can see, this is right at a level of support at the 204 level. So we'll look for some constructive here. Let's take a look over here at these other examples. One, earlier in the year, the S&P came down, made a new low, popped off of that, and then came back down and retested that new low area, and then made another rebound. We went into a range bound, then came down a third time and retested. Well, what was going on here? one, on the first retest, we have a little bit of positive divergence, and the momentum indicator had started to positively diverge and turn up. But over on this third opportunity, the positive divergence is much greater and much more noticeable. This made this third try a much higher probability trade. Same thing going on up here. We come back down to the 100-day moving average, making some new, basically a new lower low. And then over the next couple of days, we get a nice rebound, bounce. But it's on these retests over here where this would not have been a bad trade. But as you can see, as soon as it started showing weakness near the past level of past highs, that was the time to go ahead and get out of that potential trade on the SPY. But then this retest and this retest, what do we have going on? We've got that positive divergence going on, telling us that these are much higher probability trades. The question is, would you have been patient enough to wait about 2 weeks for the first one and another 5 to 6 days on the third opportunity to jump into a potential trade? And as we can see, these type of things happen quite often. And while, yes, topping is a process and bottoming is an event, sometimes those events work out over several days. And when a new lower low is in place, there's a potential, and we have now a new, kind of downtrend going on. The likelihood is that we're going to continue to drop to lower lows, and these moving averages then become our resistance areas for any type of a rebound. So I hope that helps you if you're looking to buy stocks at lower lows or close to them. And just a reminder, one, don't buy new lower lows unless you have these three things going for you. Wait for the price action to prove itself with constructive price action and a retest towards the low and then go. So we always like to just, welcome anybody who wants to become a member of the Active Trend Traders. And if you're watching this video, thanks for viewing the tech tip. You can find out more about active trend trading at this website right here. So have a great day and be careful with those lows.